Okay, again, good afternoon. Thank you for joining us for today's webinar discussing the third quarter results and just again kind of trying to keep tabs on what the true state of credit quality is. My name is Sean O'Brien, the president of QwickRate, and I am proud to be joined on the phone today by David Ruffin. David, as many of you may know, has joined our team in 2019 to build out a new set of credit administration and analytical tools that we house in what's called the IntelliCredit portal. And so David will pick up the second half of our conversation today. What we're going to discuss today, as I mentioned, just go through quickly the third quarter QwickAnalytics Community Bank Index numbers. We refer to it as the QCBI. Just to discuss some of the continually economic mixed signals, and then discuss where we think we are in terms of credit. At the end, we'll just touch on a few things that we have enhancements coming here in the fourth quarter for QwickAnalytics and IntelliCredit, and then just next steps. So each passing day, we creep increasingly closer to getting under 5,000 banks nationwide. You can see the number here at 5,067. As we discussed last quarter, asset growth has continued for banks across the country, due in large part to the consumer inflows and then also the dollars generated through the PPP programs. Deposit growth has remained strong as well, and you can see down here in the bottom graph across the board, even the smallest banks have seen greater than 10% asset growth. Deposit growth and asset growth over the last 12 months. Certainly, as we discussed and saw last quarter, yield on loans continues to drop, as does the cost of funds. But the net on that is, over a 40 or a 42 basis point decline in net interest margin, and for all of us, that is certainly a source of a weakness that we're going to have to try to continue to hold on to as much margin as we can. But with expected lower interest rates, it's certainly going to create and present some challenges. Non-interest income has been strong for a lot of banks. It's actually slightly lower than it was at the median values. Just a reminder, these are all median values, and the efficiency ratio continues to come down for banks, which is an encouraging sign. Profitability numbers, pre-tax ROA, has rolled over a little bit and was the same way this quarter. Over here to the far right, you can see what the pre-tax ROA numbers look like. Unfortunately, we see this little bit of a sloped line based on asset size. So, again, it can increasingly difficult for the $0 to $100 million banks, but still much better numbers than we would expect. So that's good. Core operating earnings is a pre-provision, pre-tax type of approach that we like to focus in on at QwickAnalytics. Those numbers rolled over slightly again, similar sloped line, but again, across the board, all pretty strong numbers. As we head into the fourth quarter of this year. Medium ROA numbers and ROE, kind of look the same. Again, a little bit of a slight rollover. Again, tiered or sloped to banks of size, but entering a more difficult phase, still fairly strong numbers. As we mentioned last time, and we'll continue to mention, and I'll mention probably in numerous slides today, a lot of what we're trying to guess is where we are with the virus, because that is going to dictate where the economy goes. I mean, we're all playing a little bit of a guessing game. Certainly we can see pockets of strength. As we discussed last time, certain sectors are certainly experiencing growth during these times, but there's many that are really literally fighting for their economic and business lives. So, I hope by the time we're sitting here next year, we can start to see paths to progress, but I do feel like we have a few quarters of difficulty ahead of us here as we enter winter. The GDP numbers for 2020 are listed here at the top. A strong quarter in the third quarter. I think this is a good reminder to really try to focus in on consistent presentations of numbers, particularly with these economic numbers. We've seen a lot of numbers annualized, to show a much stronger growth. I think the mention was over 33% or 30% here in the third quarter. That's an annualized number. So I think it's important and a good reminder to all of us, even within our banks. It's really important, and we think really critical, to consistently use the same reporting framework so that the numbers can mean more. When you're constantly trying to decipher what base your methodology you're using, you just create an inefficiency that doesn't need to exist. And so I thought I'd highlight that here with the economic numbers. I'm actually going to contradict myself and show you the difference on a subsequent slide, but I think it's important to try to keep the data in a consistent fashion. All told, as we sit here today, the economy is 3.5% smaller than it was at the end of 2019. The loan-deposit ratio is at multi-decades low for banks, and the debt to GDP exceeded the size of the economy for the first time, or for the full fiscal year, and it's the first time in more than 70 years that we've had that happen. So we are certainly entering into a continued expansion of debt, both for borrowers and for fiscally at the government level, and again will bring its own set of circumstances and scenarios and situations for us. It is going to continue to rise, I think, in my opinion, for the foreseeable future. And just as I said, a reminder: we're not going anywhere until we get this virus under control. I do think, obviously with the third quarter numbers, we are building a stronger footing, but we still do need to, create a little, around 11 million jobs to kind of get us back to pre-pandemic employment levels. If you think about the last reported month in September, where we created over 600,000 jobs, it speaks to the fact that we're probably going to need over a year to get back to pre-pandemic levels, and that's consistent with what the Federal Reserve in Chicago has laid out in their latest forecast. I do also think that without further fiscal support, we will probably see a weakening in the economy as well. As I mentioned, here I'm showing the GDP numbers a different way, and again can explain some of the confusion with how numbers are being presented. But some of the forecasts for next year are a little bit weaker, and so we're going to need some additional fiscal support. So I think as we think about it in our banks, I think a lot of this has to do with excuse me, what kind of tone we're looking to set both internally and with the regulators and just moving forward. And so as I mentioned, we're seeing mixed signals. Quarter two, we saw from the industry significant increases in the provisions. Third quarter, we're seeing more mixed signals. A lot of the money center banks and some of the regionals not only had smaller provisions, but they also, in some cases, like Fifth Third, actually pulled reserves out. So, I think it demonstrates and exemplifies there's a lot of difference of opinions on where this credit tail is all going to shake out. Excuse me. Certainly some reasons to be positive. Net charge-offs are low. Reserves are growing. Steady loan demand. Plenty of capital and liquidity. Belief in an improving economic forecast. And as a contrast to last time, home prices where 1 to 4 family was a source of, the predominant source of weakness last time, it's actually a source of strength here so far in 2020. However, on the other hand, there's reasons to be cautious. Quantitatively, everything looks good. No charge-offs. No problems. Materializing for most banks. Qualitative, it's not so much, right? You talk to borrowers. You certainly look at businesses. You can feel the anxiety as they approach the winter season, and literally and figuratively, where businesses that need to gather, we may have more reductions in capacity. Less people heading out, more people getting COVID, and maybe changing the outlook in the way we're dealing with the virus. And so all of those things can be very scary for businesses that are really, again, a lot of them teetering for their financial lives. The margin deterioration is certainly an issue. The economy is smaller. Will taxes go up next year? Unemployment levels, while coming down, still are elevated. As we mentioned, 11 million people to get back to pre-pandemic levels. And I think a lot of businesses, particularly in the service industries, are asking, can they survive another 9 to 12 months of these current conditions? Because the likelihood is, even with the vaccine and therapeutics coming to market, we're probably third quarter of next year before those are truly widespread. And then now there's some uncertainty around whether people will actually take them, in addition to uncertainty just around the actual condition of our borrowers. So again, a lot to be cautious about as we move forward. Okay, so at this point, I am going to turn the presentation over to David, and if you'll bear with me all just 1 second, I'm going to change the presenter. And I'm going to hand this to David, so I appreciate your patience while we make this handoff. So David, your screen is up, and I'll turn the presentation over to you.
Great. Thank you very much, Sean. Of course, I'm delighted to share the presentation with you today, as well as the participants on the call today. I think uncertainty in your last comment was the operative word of the day, and particularly as it relates to the credit segment that I'd like to speak to. But I'd like to remind, before we get into that, the participants today on kind of the architectural and philosophical bases that we built IntelliCredit around. And that, of course, is as a complement to the sister division, QwickAnalytics, which deals a lot with public data. We focused a lot on non-public data, on the presumption that it is within that sphere of information that really is the kind of the way that you begin to detect emerging credit risk before it becomes public data in the criticized classified category. And key concepts of that is to be able to understand the transactional versus the macro and be able to immediately identify using our technology borrowers and loans that create red flags or anomalous behavior that give us some concern. In addition to that, we've made real strides in trying to, frankly, bring loan review outside of the wilderness, so to speak, into a much more interactive and real-time combination to the diagnostics of your portfolio. So let's talk a little bit about the so-called COVID credit environment. Again, uncertainty, I think, is clearly the operative word here. And in addition to that, I would say I'm a credit guy, and some people on the call may think, well, we're going to hear doom and gloom. No, I think vigilance is really the key companion word to uncertainty. And I think that, we're talking about the uncertainty over the short and long-term effects of the economic shock, which Sean spoke very well to and in detail, certainly over the impact on your loan portfolios, and within that lies some of that clear uncertainty that we'll be a little more specific about in a second. Uncertainty over the disparate impact on businesses. Again, Sean said a moment ago, it was largely wonderful family residential housing valuation collapses that in many ways could be looked at as the centerpiece for the Great Recession a decade or so ago. Unfortunately, COVID has really left us with a whole much more diverse, disparate array of industries that are being impacted negatively, and I think that's going to be a burden on bankers to try to differentiate those industries. Uncertainty on the impact of bank valuations. If you talk to investment bankers over and over again, they'll say, and many of them have been very seasoned in their jobs, will say this is clearly the most uncertain perspective they have on bank portfolios in their entire careers, largely because of not knowing at this point where the credit quality issues may be emerging, or they have not been necessarily quantified at this point. And of course, that's been reflected in many ways on bank valuation stocks, which frankly have not, particularly in the community and regional stocks, have not necessarily been afforded the snapback on Wall Street that we saw in many other industries. Uncertainty, as again has been said over and over, the breadth and length of the pandemic, it's worth saying again, it will follow the virus, unfortunately. And frankly, as we gather together today here, we've got another factor of uncertainty, and that is, of course, the potential for uncertain election returns and the outcome being somewhat potentially litigated or unsure for some time to come. Also, uncertainty over what I consider to be, irrespective of the triteness of the comment, a COVID high, potentially masking credit deterioration in our industry. What I mean by that is, we've had massive federal stimulus. We've talked about that in the last presentation last quarter, but graphically to indicate, again, as Sean says many times, we've had so much more, exponentially more money that's been put on the street almost instantaneously in this financial or economic event than we had in the Great Recession. And that has certainly averted a catastrophic economic event, but it also, again, at least directly or indirectly, I think, has given us some sense of false comfort, if you will, in terms of potential credit risk embedded in our portfolios. We've certainly had regulatory relief in terms of suspension of the trouble debt restructuring, allowance, much more liberal allowances for extensions and modifications, and frankly, a general respite from oversight of regulators in terms of severe scrutiny of banks in the last few months. But I'm here to say that everything we're hearing is regulators are completely gearing up for getting back in a much more normalized examination process now and into next year, and with a lot of emphasis on, okay, what are you and your banks and financial institutions doing relative to this crisis, and what does it look like in your portfolios? We've certainly had, as again Sean alluded to, a flush of non-baseline loans and deposits, which undoubtedly is causing havoc in boardrooms and C-suites in terms of trying to do planning and budgeting for next year in terms of really what is organic versus you could almost argue funny money kind of PPP loan growth. Leading some bankers to legitimately say, what crisis? I was speaking to a California group a couple of weeks back and did some polling, and they indicated, well, this is really not as severe a crisis as we were told or that we may have feared. And I do certainly understand that. But again, we tend to believe, and I have over my many years believed, that a credit tail has a much longer experience than an economic shock, and we do have to kind of understand that. And again, the fact that there's been so much stimulative and regulatory kind of relief, at least in the short term, there may well be indications of masking credit quality. And we all know uncertainty is not a friend within the financial risk management sphere. The good news, as I think we said last quarter, is again we've got more capital, more liquidity, better risk management protocols in place in our industry now, and certainly no blame can be ascribed to the financial industry over any aspect of this. In fact, if anything, community banking has emerged, as I speak to trade association groups over and over in the last month or two, and it's almost hero status in terms of their activities, in some cases vis-a-vis the mega banks in terms of the PPP program. So I think that's been a hugely positive standpoint from a perception of our industry. Loan growth, again, very significant on a 12-month basis through the third quarter. Again, a lot of that is, in fact, almost none of that is really organic loan growth, and that is the issue. Even within the community bank space that we operate with, and QwickAnalytics does, as you know, largely in the 10 billion and under, so that we don't skew this with a lot of mega bank data. Even the loan growth itself, as Sean alluded to, is led largely by the billion plus or billion to $10 billion banks. In terms of, there are kind of three criteria I tend to look at, and the risk of being rather simplistic about what is your key metrics on loan quality. One is your inventory, which is your non-performing loans to loans. The other is looking at it from the standpoint of what do we do with our inventory. We either charge them off or we reserve for them. So we've taken this data and kind of segmented it by 5 regions of the country in general. And as we see here that in terms of inventory of problem loans, you've got largely the Southeast and the Southwest that have a little bit higher inventory. The West is actually the lowest inventory, and that's not necessarily surprising. This is on the end of a very benign several years, and as I said, because of the relief that we've gotten stimulatively and regulatorily, there's not really a lot of uptick at this point in non-performing loans. Charge-offs are inconsequential at this point, and 2 ways of looking at your reserves, one being how much of your reserves are covering your acknowledged problems, and in this case, the Southwest leads the country in terms of roughly 2.5 times in built-up reserves on the average basis of banks are covering their problem loans. All banks in all regions, at least on an average basis, are covering their acknowledged problems at this point by at least 2 to 1. The more classic way of looking at it, of course, is ALLL to loans, and that has ticked up as you would expect given the severity of the first and second quarter in terms of reserves. Again, the West leads in terms of an aggregate percentage of 148 basis points. In terms of concentrations, the 2 that tend to come to mind, of course, is real estate, construction and development loans, which is the 100% guidance. It's not a regulation, it's a guidance, but it does, again, behoove all banks to be sure that if they're approaching that or exceeding that, they're prepared to explain a rationale for being at that level. You have on the construction development loans 151 banks that exceed that nationwide. The largest region is the Southeast and the Southwest. Common sense probably tells you that represents some demographic shift on the presumption that higher construction and development goes on where populations are migrating to. I think the caveat there is to be absolutely sure we don't repeat the sins of a decade ago and fill that kind of lending with a lot of speculative loans. And nothing that we're seeing has much indication of that. On the broader 300% guidance, it is largely the West and the Northeast that are a little higher than the other banks. Again, it's interesting that there are 84 banks, though, in the Midwest, which is the largest single group of banks that exceed the 300% guidance. And conversely, the average bank in the Midwest is only at about 122 basis points of risk-based capital to broader CRE exposure. In terms of multifamily, you see there it's largely in the Northeast, probably understandable, and in the West, which is the West Coast. C&I loans, other than just the optics of it significantly growing through the third quarter, which is, again, largely the PPP loan program, we knew that was coming, and it continues again through the third quarter. Ag is another area which, of course, the Midwest is probably the most exposed in terms of lending from the commercial banking system. But here's another, I'll pause just a moment here on this particular case. I'm all about writing your own script. As I said, if you're looking at significant exposures, we were working with a bank in Nebraska a few weeks ago, and yes, using our tool, was able to, and we said, well, goodness, you're almost 600-700% of your risk-based capital in ag lending, but we were able to drill down almost instantaneously and look at the quality, the very strong quality of that particular bank's ag portfolio, which is an exact point of you being able to effectively disabuse what might be an initial concern by a regulator coming in, seeing that you have excessive exposure in a certain concentration. Structural challenges for smaller banks, again, when credit does become stressed, the Texas ratio is not consequential much anymore. It's the Southeast arguably is where most of the bloodshed was a decade ago, is still a notch higher. But there are really three factors in that. One, you've got less capital at the smaller bank level. You've got a linkage, if you will, subjectively, personally in some cases, to problem borrowers. And most importantly, though, is the disproportionate tie to real estate lending, arguably a very illiquid problem asset when it becomes that. But even here, the concern we have is that smaller banks, smaller financial institutions tend to keep larger levels of problem loans disproportionately. And if we have a wave coming in and I was on the call basically with a regulator last week that said that there were models being run in the regulatory arena that is projecting second quarter of next year as potentially some real strong rearing of heads of deteriorating credit. So I do think that we have to be at least being vigilant. I'm not predicting that. I'm just saying that vigilance is the key in this environment. So different this time, what do we do to look at credit in a different way? I think we have to certainly pivot, as most of the institutions are, from the COVID-related modifications and PPPs to a rather tedious loan-by-loan credit risk assessment. I think there's some talent assessment that needs to be taken, particularly if we start getting into so-called special assets and troubled assets. I'm a big advocate of banks and financial institutions, credit unions, looking at their policies because in the end of the day, in some cases, policies that haven't been tweaked in 10 years are sometimes used by regulators to entrap you around what your actual performance is today. I do believe this next few months and even a couple of years may be driven by conservatism without overreaction, and with more of a focus on reserves as opposed to charge-offs, and largely because we have so much more of a cushion of capital in place. And that's going to be a little bit tricky as it relates to valuations of portfolios if you get into M&A or recapitalization ventures, because the gold standard for credit marks on portfolios tends to be driven by net charge-offs. I think there's going to be the need for a renewed focus on loan review going forward, and certainly we're all getting used to the plethora of government guarantee programs in our strategic direction. I do think it's going to be important to, again, avoid that trap that all loans are good loans until they're bad. Early detection of loans and credit problems is going to be a critical correlation, in my opinion, towards better performing banks under stress. Big advocate of using the quantitative tools at your disposal to give your data, for your data to identify these emerging risks, and certainly far quicker than just revealing a past due loan. Focus on risk grade migrations within your past categories. That's where the early warning signs emerge. And then the most important thing from a tactical credit standpoint to me that COVID has forced upon our industry is the need to subset your portfolios by all reasonable means. In other words, there are going to be pockets of your portfolios that are tied to certain industries, certain vintages, certain concentrations of borrowers that really have totally different risk profiles than the portfolio at large. And I think staying up there just at the portfolio at large is really, missing it, because this again goes to the very heart of your need, particularly next year, to be able to write your own script, as we say, before the regulator does it for you. And also, we are very passionate about this, that take steps to make your loan review far more effective, more efficient, and more dynamic. It really is a business model that's pretty staid and dated, and we think there's going to be a lot more focus on loan review next year for obvious reasons, to make sure that early detection of emerging risk is done and done effectively. And with that, I think I will believe we're ready to go back to Sean.
Okay. Thank you, David. All right. Bear with me one second. So, make my presenters go away. All right, well, thank you, David, very much. Just as we kind of wrap up here, we wanted to share with you some enhancements that are coming to both QwickAnalytics and IntelliCredit. The first one is an improvement to our interactive credit stress test. We were hoping to have that released here this week, but it looks like now it'll be December, but it's going to allow for you to select your own historical stress periods, different from what we allow you to do today between 2009 and 11, which we use for the stress periods. You'll have some additional knobs that you can turn. You'll be able to incorporate your own internal capital triggers, and you'll be able to incorporate capital raises if you would like. So look for that in December. We'll be having a webinar on the 16th and 17th of December to demonstrate the new interactive credit stress test. In addition, we'll be releasing a credit research data. This will allow you to create your own user-defined graphs of credit data along with overlaying FRED data to it. So we're excited about just trying to make and allowing you to access FRED data more easily than you might be able to today, but all again within the QwickAnalytics platform. For those banks that are traded over the counter, there's a new there's the time to gain compliance with the new SEC Rule 15C2-11. We've designed an interactive page, interactive investor relations page that will meet those new requirements. We believe you'll find it's much more cost-effective than maybe some of the providers that are out there today. It's able to be managed by you or us. So we will be doing a webinar on that new offering in December as well. So please look for those if that is something that you might want to either look to save money on what you're currently doing today, or if you need to have an update to your investor relations page that will allow your stock to continue to be traded. The Excel add-in tool that many of you utilize, we've had a number of requests from users to incorporate the credit union data incorporate credit union data into QwickAnalytics. The first place we're going to do that is with the Excel add-in tool. This will probably be the one that's in January before we release it, but we're working and testing on it now. So look for that in January, that you'll be able to pull that credit union data if those are bank or credit institutions you'd like to compare yourself to at your bank. These are just some of the screenshots from the new credit research page. You'll see here you can add your own metrics. You'll be able to pick your date ranges, and you'll also be able to overlay FRED data. Here's an example of adding those metrics. You'll be able to pick your graph, tailor it to your region, and overlay those, again, depending on the metric you want and the FRED data that you want. So we're very excited about this and look forward to your feedback on ways that we'll be able to, once it's released, to continue to improve it. The investor relations page, this is just a quick snapshot of one part of the interactive pages, but you'll be able to input all of your own information. We give you the very easy-to-use templates. So again, you can manage it yourself, or we can manage it for you, but then once all the information you select to have out there, you'll be able to see it in a page, a very condensed and consolidated page that looks something like this. So again, please look for the webinar discussing and detailing the investor relations page. And finally, the credit stress test. We've tried to make this a bit more interactive, like our CECL solver. For those of you who've looked at the CECL solver, we've gotten really good reviews on the ability to interact and kind of create different scenarios on the fly. That's what we've really done here with the credit stress test. As you can see here, you'll be able to customize 2 years of projections. That's obviously still in beta because that's spelled wrong. You can modify the portfolio for guaranteed loans. That's a request that we've got, that particularly with the PPP loans and some other government guaranteed loans, we've had banks ask us to be able to modify their portfolios. Again, another typo. I should have checked those before a little closer. The look-back periods, you'll be able to change and choose, pick your own peer group, run the scenarios, and then export those much in the same way. This is just an example of where, again, you'll be able to put in your own internal capital targets In addition to, you'll be able to factor in equity raises or capital raises, excuse me, if you would like. The add-in tool, again, will be focusing in on adding the credit union to be able to layer in with your otherwise bank industry information. So you can see we're trying to build and continue to build and enhance affordable, easy-to-use solutions. We understand if you don't want our help, but we do really think that we've created some things here that can, as David touched on, just make all of you more efficient. The buzzword in our industry right now is fintech. Fintech can take a lot of different shapes and sizes. Oftentimes we look for the very big idea, but those tend to be very difficult to incorporate and implement. And really what fintech can simply be about is doing something that you're doing every day and just making it easier, more affordable, and just better. I think of the mortgage app, right? The mortgage app used to fill out on paper. Now everybody has a digital online app. The app's still the same thing. We've just made it easier for our borrowers to take into account, and it's made us all much more efficient. A lot of the tools that we're building here at QwickAnalytics and IntelliCredit aren't designed to be revolutionary. What they are designed to do is to make the jobs that you're currently doing save you time. We do a lot of the aggregation for you so you can do the analyzing. That's what we're striving to do, and do that through technology that's constantly available, affordable, and an improvement upon maybe the way you're doing things now. We think during COVID, it might be a good time to evaluate those types of services, right? See if we can save you money with the different solutions we have compared to what you're doing today. We'd love to see if we can help you do that. So we invite you to review QwickAnalytics or IntelliCredit if you haven't already. If you are using us, we thank you for doing that, and continue to reach out to us about new ideas, new solutions, the things that we're adding. We'd love your feedback so we can continue to improve our solution. As I mentioned, if you want to, one of the things that we'll be doing for banks that do use us for loan review, we will be providing complimentary access to the portfolio analyzer. So we think this represents a perfect example of improving something you're already doing. We can do the loan review for you, and you'll get a new analytical tool for the next 12 months. We think it's, again, it will be an improvement and an enhancement of service for you. So we invite you to learn more about that. Okay. Finally, I'm going to turn this a little bit back over to David with a few more thoughts about the uncertainty ahead.
Yeah, relative to the products that we do offer in the long tradition of the QuickRate family of products and services, we are, again, aspire to build this with practicality and affordability in mind. And I'd like to leave you with just these 4 questions that I think, again, we embedded clearly in our capabilities with our own fintech solution, and that is, can you navigate between your macro or aggregate portfolio and your transactional or loan-by-loan risk, and do so very easily? Again, all of these are geared towards writing your own credit risk profile script before the regulator does it for you. And do you know your credit hotspots, as I alluded to earlier, in terms of your ability and need to, particularly post-COVID, to subset your portfolio? Can you customize your own view of the portfolio? As I indicated, the gentleman CEO from Nebraska who said, well, my ability to counter a potentially negative perception of my portfolio, particularly the risk-based capital, lies in my ability to show them instantly why I'm comfortable with 600% exposure to ag lending. And does your loan review interface in some form or fashion with a more real-time portfolio diagnostics and not just be a standalone one-off engagement? And the most important thing I think we have to, and this comes from years of working with bank management and bank boards, perhaps one of the most dangerous patterns that develop between bank boards and bank management is the degree of credit surprises that come down the pike. And all of us, of course, want to avoid as many of those. We know they will come, particularly if stress gets that much more pronounced, but we certainly believe that all of our tools at IntelliCredit are designed to answer and be a solution to each one of these questions. And so we certainly would love to have the ability to do a one-on-one demonstration with you and discussion about how this potentially could work affordably and practically at your financial institution. Sean?
Thanks, David. Again, we'll open it up to questions. If you have any, you can click on the icon and submit those now, and we'll take any that you might have. And then just leave this page up here as a reminder. There's a number of different ways that we'd love to expand our relationship with you, see if there's additional services that we can provide you, all designed to just again help you employ and deploy affordable, we believe, efficient creating technologies to help you at the bank. So I don't see any questions. So at this point, on behalf of David and myself, we'd certainly like to thank you for your time today. Thanks for working with us at QwickRate, QwickAnalytics, and IntelliCredit. We'll look forward to seeing you next quarter. Please submit any ideas or emails with any other ideas where you'd like these quarterly updates to maybe touch on or go into. We'd love to hear your feedback. But otherwise, we'll talk to you soon. Stay safe, stay well, and all the best. Bye now.